Hello and welcome to this special conversation at Moody's and ICRA 4th Annual India Credit Conference, wherein we are discussing India's fiscal policy challenge. Revision at Moody's and ICRA 4th Annual India Credit Conference, wherein we are discussing India's fiscal policy challenge, reform progress and growth outlook. But let's bring our focus to the banking sector, which is really under the spotlight right now with all the NCLT resolutions taking place, NPA clean-up drive by the government and the recoveries that the banks are receiving. Hello and welcome. We have Alka Anabarasu from Moody's and Karthik Srinivasan of ICRA with us. My first question is to you, Alka. So Moody's had last year assigned a stable outlook for Indian banks, but that was on the back of all the progress that was taking place in managing the bad loans. But we are in a situation right now where we are seeing that the bad loans for banks have gone up and the resolutions are also getting delayed. So do you still maintain that outlook?
Sure. So from an outlook perspective, we do think that banking system outlook will broadly remain stable for the period going ahead. And actually, I would just put our stable outlook in the context of our ratings. So this stable outlook has come after a long period of downgrades of the bank ratings. So where we are with the bank ratings, we think the upside and downside risk are equally balanced. Now, from an outlook perspective, I think you touched upon asset quality and the fact that NPLs have only risen. We think this is in a way a good thing because banks have come out clean with the balance sheets. The NPL push has meant that we think NPL recognition cycle is coming to an end. Clearly, resolution is a big topic right now, and how these assets, huge stock of NPLs will get resolved. But from the bank's own capacity to resolve these NPLs is increasing. So the system's coverage ratio for NPLs has broadly remained stable in the last year at about 50%. We think if banks can provide all their operating profits towards provisioning, their provisioning cover ratio can go up further, and this will increase their ability to take haircuts in the upcoming NPL resolutions as they go ahead. So from a system outlook perspective, asset quality, we think we are nearing the end of the cycle. Capital, there is capital support coming in from the government. And if the banks are able to resolve the challenges on the balance sheet, which is not just a 12-month topic, but a bit longer-term topic, their profitability should improve from there on. So from that perspective, it still supports our view that stable outlook of the banking system is still justified.
All right. So you're maintaining a stable outlook for the banking system in India. But let me come to you, Karthik, on that. So she mentioned that asset quality remains an area of concern for the banking system. So what is your outlook as far as the asset quality for banks is concerned in fiscal year FY19?
We think over the last couple of years with the regulator pushing banks to recognize their stressed assets upfront, a large part of that has done. So we believe that one can say that the asset quality issues have almost peaked out for the banking sector. If we were to just look at the reported numbers, we're already at about 11.8% in percentage. In terms of absolute value, we've crossed 10 lakh crores by March. Beyond this, there will still be some slippages. You can't rule out slippages, but what we think is there will also be some improvement on the recoveries. So to that extent, by the end of FY19, we should see reduction in percentage as well as in absolute terms. Couple of large resolutions as and when they happen would obviously provide fillip. We've had one resolution from an NCLT one account, the Bhushan Steel one. Another one is near completion. So assuming some more resolutions happens at haircut levels which are at least in line or lower than expectations, that should be sort of beneficial to the system.
So we are seeing that recoveries are coming in, and banks are also hopeful that as Karthik said, that by March 2019 we will see some resolutions happening and most of the recoveries coming in. And the government has pushed for capital infusion in the public sector banks. So by when do you expect this? And most PSU banks, as we saw in Q4, posted loss on account of RBI's February circular. And there were a lot of slippages because they had to make higher provisioning for the new cases, for the new NPAs that came in. So when do you see that banks will actually start making profit? What is the timeline that you put to it?
Sure. So from a timeline perspective, our outlook usually goes till 12 to 18 months. In this period, perhaps we may not see profitability for all the public sector banks return. So in this year as well, we expect the provisioning burden will remain high. We don't expect that the bank's profitability will be in the red. It's significant red as we have seen this year. It may actually come down, but we don't expect that all banks will become profitable, at least in this year. It is perhaps a next year topic. But if the provisioning coverage is reaching to a level where the banks can potentially start taking haircuts, and the fact that new NPL accretion should be lower than what the banks have experienced in the past 2 to 3 years, then we expect that the profitability profile will gradually start to improve, and we may just see more banks becoming more profitable in the next in the fiscal 2020 year.
But most banks were hopeful that by Q1 of FY19 or maximum Q2, we will see most resolutions coming in. But given all the delays, banks are now concerned, and in fact some bankers have already said on record that this will spill over to the Q3 also, could spill over. So if we have to talk about an outlook on profitability, so how do we look at it? Will it take some more time, maybe go beyond FY19?
Sure. So on the resolution, which is getting a bit delayed, I mean, clearly this is a new process, and perhaps everybody is learning as the process is moving ahead. There are teething issues, and that is something potentially everybody was expecting to some extent. We'll need to see how the process evolves, because ultimately these are legal issues where we don't know what kind of outcomes will come out. But we do expect that resolutions will take place. The whole machinery is in place. It's just about getting it functional now. When it comes to the profitability, we think this year banks will still need to provide for the NPLs, build up their provisioning buffer. In addition, NPAs is coming in next year as well, which will also mean that the provisioning needs may be significantly different than where banks are right now. So we don't expect that profitability will return for the system as a whole in this year. We will obviously not expect all banks to report losses, and we expect some of the stronger banks will report profits in this year, but we will not expect all banks will be profitable. But profitability to recover is potentially a next year topic, and if the resolutions start taking place, and it's again a question of what kind of haircuts banks need to take in those resolutions compared to where the provisioning is. If the provisioning is adequate to absorb those losses from the resolution, then we think that the profitability profile will improve from there on.
All right. So you're saying that profitability profile should increase, but not as soon as in FY19, should spill over in the next year. Let me get back to you, Karthik. So we have seen this constant conflict and divide as far as the IBC law is concerned. We see that some are of the view that value maximization should be the ultimate goal in getting the cases resolved, NCLT cases resolved, and some are of the view they have strongly advocated that adherence to the law should be our primary goal. So what do you think should be the path that should be followed as far as the NCLT resolutions are concerned?
I think it's tricky because one has to have a fine balance between the two. You can't take one at the cost of the other. But at the same time, the position where we are in, I guess timely resolution is more important. I mean, if you would ask me, possibly a timely resolution, one can give a greater weightage as compared to value maximization, at least at this point in time. You need the system to come back on track before you look at the value maximization on each and every case. So if you want to try and do a value maximization on each and every case, that's going to be a problem. That would in all likelihood just derail or prolong the recovery process, which is only going to be detrimental to the economy at large. So there would be few cases, but one will have to take a case-by-case call and sort of close it out. So
you're saying that managing the time should be our focus and not...
No, managing time is I'm not saying that you need to completely stick into the 180 or 270 day timelines. Here we're talking of NCLT 1 and also to an extent NCLT 2, a list of cases. These are large value cases. So obviously, and these are the first set of cases. So there are teething issues, how we lay down the systems, processes, and which could be a benchmark for other cases to be followed during the process. So won't be surprised if for some more cases there are some more delays, but it shouldn't be so inordinate that the whole process becomes meaningful. In the past, our biggest issue has been the resolution never happens. We just prolonging the recovery process. Now that we have stipulated on ourselves a timeline within the IBC framework, a best case scenario, it gets resolved within that. But a more realistic, even if it happens a couple of quarters here or there, I guess it should be manageable, but certainly not beyond that. Then you're defeating the whole purpose of setting up the framework and ensuring that the lenders are back into the risk-taking game.
Okay, so this is actually, we know that this is a testing ground for IBC also. So everything that we are seeing is actually being tested and then going through. So, but I'll shift my focus to the RBI hiking rates, the key lending rate yesterday to 6.5%. So, do you see, Alka, any impact on the retail loan books of the banks, especially home loans, and will the home sales get impacted because of this?
So essentially the rate hike, I think the banks have already increasing the lending rates for some time. The liquidity in the system had come down. So from that perspective, there was already pressure on lending rates. Clearly the hike in policy rate means that the MCLR of many banks will also get adjusted.
Correct.
So that will get passed on to the loans which are on MCLR basis, and clearly home loans will be affected. Your big picture question is, will that affect home sales in the economy or not? But at least, clearly the construction sector is perhaps booming in some parts, but it's subdued in many parts of the country, and especially the big tier 1 cities, where actually the big ticket housing, luxury housing sector is quite subdued. On the other hand, the affordable housing sector is booming or growing quite rapidly. So from that perspective, a shift, the interest rate hike has happened. Some of it is already priced in with the banks, in the bank's pricing already. It may make things more expensive, but I don't really have a view whether that would really be detrimental to new home sales in the economy. But if we go back to the big picture thing, clearly more rate hikes are possible, especially when we look at the global environment. Fed has already said that there could be more rate hikes coming in this year. So the question is whether this risk is already being priced in by the banks or not, and by the home buyers as well or not, because this could mean that their monthly payments could change very quickly if the global interest rate environment turns as it's anticipated as well.
All right, I'll come to you, Karthik, now. We have seen that after this entire NPA mess, banks have largely shifted the focus to the retail segment, and banks are in fact willing to boost their retail segment and not focus less on the corporate side. But then we should also see on the other side of it, do you see that the corporate side will ever revive again?
It would, but it'll take some time. Again, it's difficult to give a generic answer. We are seeing some sectors, increase in demand. For example, the auto sector. So we are seeing a revival of demand in a couple of sectors. But at a broader level, if one says corporate would take some time, you also need to take into account that last couple of years we've not had any new project or a capex announcement. So a large scale or a huge quantum of requirement from a corporate is some time away. Whatever is happening today, it's more of a refinancing of projects which got completed, or a refinancing from a higher interest rate to a lower interest rate, as the interest rates were pretty benign till about 2 quarters back. So you had a lot of bond placements which sort of helped reduce the interest cost. But otherwise, corporate would come up, but probably take some time. And so from a bank's point of view, that's been the reason. The demand from corporate is slowing down, notwithstanding the last 2 quarters where, because of a rise in crude, the GST as well as the FX related issues, the working capital requirement is definitely inching up for the corporates as well. Though no material capex requirement, but working capital front, yes, the demands are going up. And from a bank's point of view, with they being deficient or constrained on capital, they're also looking at other ways to conserve capital. Raising equity from the market seems to be very difficult or impossible at this stage. Government is yet to announce out of the remaining kitty of the recap which bank is going to get how much. So banks currently resorting to selling off non-core assets or looking at retail assets because they carry lower risk weights. So one is trying to, so to that extent, the focus of banks has definitely shifted towards retail assets. And it also helps that while the delinquencies on the retail assets are also going up, they are still far more manageable and more granular in nature as compared to concentrated wholesale exposures.
Right. So can you put a timeline as to when we will see revival in the corporate lending books, if at all there has to be some?
So that looks very difficult. You've not had, as I said, the only opportunities which you would get is refinance.
Right.
And now with interest rates going up, refinance again becomes a question mark. Why would you refinance at a higher rate? Correct. Number one. And number two, we've not had any large-scale project announcements. So even if you were to assume some project announcement today, by the time you have a financial closure and the actual drawdown happens, you're probably a couple of years away. From a large-scale corporate requirement, you will obviously have requirements on the working capital front or small expansions here and there. So that would possibly continue. But if one is looking at a large-scale capex kind of a thing, I guess that is some time away.
All right, so that is going to take some time, but I'll get to my last question here, and that is to you, Alka. So what are the key drivers that you're looking at which will boost growth in the banking sector this year or maybe going ahead?
So amongst the driver, perhaps two aspects. So one is how the balance sheets get repaired, and which is not really a 12-month topic, but maybe a 12 to 18-month topic, how the balance sheets get repaired. And if the banks have cleaner balance sheets, their ability to come back to the market will go up. And the second is the capex cycle when it comes back to the economy. The government is doing some capex, but really the private sector when the capex cycle comes back, and that will again be a driver of growth in the sector.
All right, thanks to both of you for talking to Business Television India.
Thank you.
Welcome back to this special conversation. I have with me now Vikas Halan from Moodys and Anjan Ghosh from ICRA to discuss really the corporate side of it and really how the domestic Indian corporates have performed and what are the challenges and opportunities that one sees in each of the sectors. Let me ask you, Vikas, first, on the domestic growth story, what's supporting the cause and which are the pockets and sectors that you think are really driving this growth and will continue, more importantly, to drive it even in the coming year?
So the domestic growth expectation that we have of the 7.3% next year will largely translate into a lot of consumption-focused sectors. In terms of sectors that are more capital-intensive, we yet to see that growth translating into that. But having said that, if you look sector by sector, sectors like refining and marketing, where India's capacity expansion has been growing significantly, and if you look at telecom, where there's high capital intensity, most of the telecom operator has been investing to expand their network and also upgrade their network to latest 4G technology. And if you go further into more auto sector, for example, where there has been revival in demand, and therefore there is new product launches and do new product development as well. So we see for sectors where the demand growth has translated into capital intensity, and there are of course sectors where the capacity utilization has been not as high, and therefore capacity expansion is not taking place. So when you translate all of this, the EBITDA growth for the corporate sector as a whole, we see that slowing down a little bit, but still being very healthy. Last year we saw significant EBITDA growth for most of the corporates we rate, and this year also we expect EBITDA growth to continue, albeit at a slower pace. This is going to be driven by GDP growth, online capacity coming online, and also with commodity prices helping them increasing their earnings.
Of course, they're passing it on, and that is aiding their margins in that sense, or at least it's ensuring that that is not being compromised. What are the challenges, Anjan, that one sees in the India Inc. space? Because we've been talking to a lot of these corporates, and I'm sure the sense that you also pick up is that while they are seeing positive signs and not yet 100% confident to go out there and invest fully. Of course, production utilization is being looked into first, and then the expansion bit comes in. But each time you talk to them, they say private investment will actually follow public infra investment. How true is that, and what's your own assessment and sense on that?
Okay, if you see last 5-6 months, the lead indicators which we track, I mean, most of them have been showing very good growth. I mean, most of it is consumption oriented, but even otherwise things are definitely improving, in a fairly broad-based manner. If you look at yesterday's RBI policy, the capacity utilization has gone up to around 74% in Q3, which is significantly higher than what it was maybe a year back.
Sure.
So things are definitely, the trajectory is positive, and we are seeing the first signs of revival in capex, even private capex in areas like cement, steel. Large projects have been announced. Passenger vehicles and auto components he has already covered. Food processing, a lot of consumer-facing industries. So clearly it's not a broad-based revival, but yeah, there is capex happening even at the private sector level. So to that extent, things definitely are looking much better.
Much better. Okay, so that is a positive, encouraging sign. We're talking about the oil and gas sector, and I think that also has seen its own course. We've seen the oil prices go up quite significantly now. Some bit of cooling off has happened, but what is the outlook there, and how bullish are you on that space, and when do you see that sector perform in a significant way in the overall economy?
So our view on oil prices is that oil prices will remain volatile, but also range bound. So our base case assumption is that oil prices will average anywhere between 45 and 65 in the medium term. And if you look at WTI Brent differential and you add that $5-7 on top of that, then the Brent average, the top end of our range, is about 70 to 73, which is not too far from where the prices are. And if you look at the overall April to May this year also, the prices have not been very far from that range. We do not expect that prices will continue to be at the top end of our range for a longer period of time. The most important thing to look out for over the next couple of weeks is the OPEC meeting and what they decide with respect to production cuts.
That will, of course,
we will do. Market is pricing in a bit of a paring back of that production cut already, just like market already priced in the Iran sanctions before they were put in place. So I think it's not going to result in significant softening of the price from here.
But it is going to be range bound, as you say.
Unless US production actually comes back more strongly in the second half this year, which could bring down prices a little bit more. So overall, we do think the prices remain range bound, but volatile with the geopolitical tensions and whatnot.
Okay. And finally, Anjan, the refinancing needs in 2018. I mean, we are talking about what has happened in the RBI policy, which is a rate hike, which again, while, you're starting to see people looking for expansion, but a rate hike is not such a good news in that sense. So what are the needs that are coming or emerging? As you said, we are already at 74% capacity utilization. So what's your sense, and how well will they be met? Or you think there could be a liquidity crunch?
See, I think for the larger, of course, interest rates going up both domestically and internationally is definitely a negative. I think also what has happened this year is the bond markets have really, bond market was emerging as a big source of funding for corporates, and it was growing at a very high rate last 4-5 years. So that trend has got reversed. And even with commercial paper rates, etc., very high now. So reliance on the banking system has increased again. So So that is a cause of concern because a lot of banks on the PSU side are not in a position to lend. The bond markets are not active for a variety of reasons. So in case there's a real investment demand picking up, so yeah, that is a concern. And of course, the larger rated, the large corporates, the better rated corporates, I don't think will have an issue in terms of refinancing or accessing funds. But yeah, the medium size or the smaller sized corporates, and also the fact that overall working capital requirements are also going up because of increasing commodity prices. So, overall funding requirements are going up, and so that is a challenge. That is going to be a challenge.
That will be a challenge. Okay, gentlemen, thank you very much for your time. Nice to speak to you.
Thank you.